Welcome to the deep dive. You send us what you're trying to figure out, and we get right to work. We pull out the key insights so you can get informed, without getting bogged down.
Exactly. We sift through it, highlight what really matters, and try to make sense of it all for you.
So today, we're tackling a YouTube video. It lays out an intraday trading strategy for crude oil called the Eagle strategy.
Right.
This one's from the E&T Trading School channel. The video title is, let me see, Daily 5,000 Profit Crude Oil Intraday Trading Strategy. MCX Crude Oil Trading Strategies in Hindi.
Yeah, and it makes some, well, pretty bold claims, especially if you're into trading.
Like what?
They talk about a really tight stop loss, so you limit your downside,
Yep.
but also a big profit target. And they claim high accuracy, something like 80%.
80%.
Yeah. The idea being if you stick with it for, say, a month, you could end up profitable overall.
Okay, that would definitely grab your attention if you trade crude oil, right?
For sure.
So our mission today is to really dig into this Eagle strategy. Let's figure out how it's supposed to work, pull out the essentials from the video for you, hopefully uncover some of those, aha moments.
Sounds good.
Okay, let's unpack this Eagle strategy then. What's the basic concept?
So basically, the Eagle strategy is all about watching for specific candlestick patterns.
Okay.
And these patterns need to form around the 21-period moving average. It's specifically on a 15-minute chart and just for crude oil futures.
Right, so it's reactive, waiting for the price to do something specific near that average line.
Exactly. It's not about predicting huge moves way in advance. It's about reacting to the price action in that time frame, using that one indicator.
You said 15-minute chart, 21-period moving average. Those are like the fixed rules.
Absolutely. The video is really clear. 15-minute chart only. Keeps it focused on intraday moves. Yeah.
Right.
And the only indicator is that 21-period simple moving average. It just, averages the closing prices of the last 21 candles, gives you a sense of the recent trend.
Okay, a simple average line on the chart.
Yep. And the whole strategy hangs on how the price interacts with that line.
Got it. So price is moving, gets near the 21 MA. That's when things get interesting. Let's do the buy signal first. What are we looking for?
Okay, for a buy signal, first, the price needs to be trading generally above the 21 moving average.
Above the line. Okay.
Then you watch for a red candlestick. That candle needs to actually touch or get really close to that moving average line.
So a red candle means the price went down during that 15 minutes, right?
Yeah.
And it dips towards the average.
Precisely. That's the setup. Now, the trigger that comes next.
What's the trigger?
You need the next candle to be green, meaning price closed higher. And importantly, that green candle has to break below the low point of the red candle that touched the average.
Mm-hmm. Okay, so red touches, then the next one is green, but it actually dips lower than the red one did.
Yeah, it sort of suggests that downward push was rejected and buyers might be stepping back in.
Okay, interesting. So when do you actually, hit the buy button?
The actual entry comes on the candle after that green one. If that candle breaks above the highest point of the green candle...
The one that broke the red's low.
Exactly. If the next candle breaks its high, that's your buy signal. It's seen as confirmation the upward move is likely continuing.
Right, okay. Red touches average, green breaks its low, next one breaks a green's high. Buy. Makes sense. How about protecting yourself? The stop loss.
Yeah, crucial bit. The video says put the stop loss euro below the low of that green candlestick.
The middle one, the one that broke the red's low.
That's the one, just 2 below its lowest point. So it's quite a tight stop. That's a key part of their risk management idea.
Small risk.
Okay.
And the reward, the target.
They aim for a 50-point profit target primarily.
50 points.
Yeah. But they do mention you could aim for smaller targets too, like 40 points, maybe even 30.
Why would you do that?
They suggest it might increase your win rate, your accuracy, so potentially more winning trades, even if each one is a bit smaller.
Interesting trade-off. Higher accuracy for maybe slightly less profit per win. Okay. Now, flip side. How about selling, going short?
Right, the sell signal. It's basically the mirror image, like you said.
Okay.
So this time, price needs to be trading below the 21 moving average.
Below the line.
And you wait for a green candlestick to touch or come close to the moving average from below?
A green candle reaching up towards the average line. Gotcha.
Exactly. Then the trigger is the next candle, which needs to be red.
Price going down.
Right. And that red candle needs to break above the high point of the preceding green candle.
So the green tried to go up, touched the average, but the next red candle pushed even higher briefly, then failed.
Sort of, yeah. It breaks the green candle's high, suggesting that upward attempt failed and sellers might be taking control.
And the entry point for the sell.
You enter the sell trade when the candle after that red candle breaks below the lowest point of the red candle.
Okay. Confirmation the downward move is on.
That's the idea.
And the stop loss for selling.
Placed euro above the high of the green candlestick.
The one that touched the average.
Correct. Again, keeping that risk tight. Just euro above the high this time.
And the target for the sell. Still 50 points.
Yep, same target. Aiming for 50 points profit on the sell side, too.
Okay, so we have the entry, stop, target rules for both buy and sell. But you mentioned filters earlier. It's not just about spotting these patterns anytime, anywhere.
No, absolutely not. That's really crucial. They have a couple of key filters. First one is time.
Time.
Yeah, they strongly suggest only taking trades after 3:00 p.m.
After 3 p.m. Why then?
Well, they say trades before that might be slow, maybe less reliable signals. They don't dive super deep into the why in this video, but it likely relates to market volume or volatility picking up later in the session for crude oil. You probably want to check if that timing makes sense for the specific contract you watch.
Interesting. Later afternoon trading. Okay, what's the next filter?
Inventory days. They say specifically of trading on Wednesdays.
Wednesdays, because of the crude oil inventory reports.
Exactly. Those reports can cause huge, unpredictable spikes in price. Big volatility. It can just blow patterns like this out of the water. They even mention having another video just about handling inventory days.
Makes sense. Steer clear of the big news days if you want cleaner patterns. Any other key considerations?
Yes, and this is huge. They really, really recommend practicing and backtesting this strategy first.
Before using real money.
Absolutely. Watch it live, maybe on a demo account, see how it actually performs, get a feel for it, build confidence before you put capital at risk.
Which is just, solid advice for any trading strategy, isn't it?
Totally. Got to do your homework.
Okay. Now, the video apparently shows some examples on a chart, which is always helpful.
Yeah, it does.
Let's talk through a few. The first detailed buy signal they showed, how did that play out?
Right. So in that one, price was above the 21 MA, like the rule says.
Yep.
Then a red candle came down and touched the average. The very next candle was green. And crucially, its low went below the low of that red candle.
Okay.
Then the candle after that green one, it broke above the high of the green one. That triggered the buy entry.
And did it work?
Yeah, that trade went on to hit the 50-point profit target. So a textbook example, according to their rules.
Nice. Okay, what about the first sell example they highlighted?
That one happened after 3:00 p.m., so it fit the time filter.
Good.
Price was below the moving average. A green candle went up, touched the average. The next candle was red, and it broke above the high of that green candle.
Triggering the setup.
Right. Then the entry happened when the next candle broke below the low of the red candle. And again, that trade moved down and hit the 50-point target.
Okay, another one following the rules, hitting the target. Did they show anything tricky? Like, what about that signal that apparently showed up before 3 p.m.?
Yeah, they did. There was a case where the candlestick pattern for a buy signal formed correctly, but it happened before 3:00 p.m. And the creator pointed it out specifically not to take it because it broke the time rule. Even though, interestingly, that particular trade did eventually go up and would have hit the target.
So they're really emphasizing sticking to all the rules, even if it looks tempting.
Exactly. Discipline over chasing every pattern.
Right. What about the day with multiple trades?
Yeah, there was an example where price crossed above the MA after 3 p.m., then dipped back to touch it, setting up a buy signal.
Okay.
That buy trade worked, hit 50 points. Later, price fell below the MA. Then a green candle came up to touch it, followed by a red candle breaking its high at the sell setup.
So a sell signal later on the same day.
Yep. And that sell trade also worked, hitting the 50-point target. So it shows you can potentially get multiple signals if the price action fits the rules.
So it's not strictly one trade a day then. Depends on the interaction with the MA.
Okay.
And they showed a trade on an inventory day, even though they said not to.
They did, yeah. Kind of interesting. They showed an example where the pattern formed on a Wednesday, triggered, and actually hit the target. But they immediately followed it up by reiterating their warning against trading on inventory days. It was more like, see, it could work, but seriously, don't do it. It's too risky with this strategy.
Okay, so the caution stands even if one example worked out. Got it. And there was one more sell example later on.
Yeah, a pretty clear one. Price below the average. Green candle popped up, actually went slightly above the MA, then closed back below it. Then a red candle followed. The sell entry triggered when that red candle broke the low of the green one.
And that one worked too.
Yep, resulted in a 50-point profit as well.
Okay, so across the examples, we're seeing the rules applied, often leading to that 50-point target.
Yeah.
Now, that title. No loss intraday trading strategy? That sounds impossible.
Right. Yeah, that needs clarification.
How should we interpret that?
Well, they're definitely not saying every single trade will be a winner. I mean, that just doesn't happen in trading.
You're kidding.
The context suggests they mean no loss in terms of overall profitability, because they claim that high accuracy, like 80%, combined with the risk-reward risking maybe 2 points plus slippage commission to make 50 points.
So the winners should be much bigger than the losers.
Exactly. The idea is, over many trades, the wins are substantial enough and frequent enough, hopefully, to more than cover the losses from the trades that don't work out. It's about positive expectancy over time, not zero losing trades.
Ah, okay.
Yeah.
A statistical edge, not a magic wand. That makes way more sense.
Definitely.
All right, so to wrap up the strategy itself, can you give us the quick rundown, the key parts of this Eagle strategy?
Sure. So number 1, 15-minute chart for crude oil futures. Number 2, use only the 21-period simple moving average.
Okay.
3, look for specific candlestick patterns when price touches the MA. Red candle touch when above for buys, green candle touch when below for sells.
With specific triggers based on the next candle's breaking highs or lows.
Correct. 4, stop loss is tight. Just 2 below the low for buys or above the high for sells of that key middle candle. 5, target is 50 points.
And the filters.
Right. 6, only trade after 3:00 p.m. 7, avoid Wednesdays, the inventory report days. And finally, maybe most importantly, backtest and practice extensively before trading live.
Yeah, that last point feels critical. Seeing it in a video is one thing, but proving it works for you in the live market, that's different.
Totally different ballgame.
Okay, so this deep dive into the Eagle strategy gives us, and you listening, a very concrete example of one specific approach. Hopefully breaking it down like this helps you understand its components and, importantly, the conditions and warnings attached.
Absolutely. It's a neat example of technical analysis and action price patterns, one indicator. But yeah, understanding the rules is just step 1, isn't it?
It really is. And that leads to a final thought for you. Considering how much the video stressed backtesting and managing risk, what specific steps would you take? What would you prioritize before actually trying out any new trading strategy you come across, whether it's this one or another? Something to chew on. Thanks for joining us for this deep dive.